Let's go to Sangeeta Purushottam, Managing Director, Nine River Capital. Sangeeta, good morning. Thank you for joining us. We have come out on the right side of the event: credit policy, rate cut, HCL numbers, and broadly the global environment is also stable. So then why are the bulls struggling?
I think, as far as the India growth story is concerned, there are concerns over and above the interest rate cycle, which is essentially linked to policy. And I think that is something which is specifically holding us back, which is why despite a very strong and a better than expected rate cut, there still remains skepticism about these, pick up in the growth cycle, particularly the investment cycle. And we've seen a lot of comments come out from various industry leaders talking about, many other issues related to, say, for example, land acquisition, other issues which are dampening the investment sentiment. So I think there's skepticism whether we'll get our act together on many of these other issues, and therefore the rate cut may not be enough.
Sangeeta, what's the view on autos? Considering the auto index itself is at close to a fresh high, you have now the Ertiga trigger for Maruti Suzuki. The management as well is pretty bullish on that. Tata Motors, in any case, JLR has been doing wonders. And Bajaj Auto also, with them looking at venturing into newer markets like ASEAN, or for that matter, Brazil as well. Things are looking good at that space.
Yeah, I think, at least the rate cycle should benefit autos. Also, if as we go along we do see a cut in commodity prices, that's something which is potentially positive for autos. But within that, I think it's become a fairly stock-specific kind of story, because, for example, on tractors or the agri piece, we're beginning to see some headwinds coming from a slowdown. Whether that translates into lower demand for two-wheelers, one doesn't know. We're also coming off fairly high base. So it's going to be a fairly mixed picture as far as autos is concerned. I don't think it's a story where every stock in the sector will move.
Pharma is the new buzzword on D Street, and everyone is of the view that buy pharma stocks because they are defensive. But are pharma stocks really defensive? Because companies like Ranbaxy, Cadila, Dr. Reddy, they have the most unpredictable business model. Their fortunes are linked to global growth. Their realizations are dependent on US FDA approvals, and their margins are dependent on global commodity prices.
Yeah, I think you're absolutely right. There are a lot of issues, which could throw growth off, or specifically relating to each company. One product doesn't do well, and you could be in for a flattish year. So I think those concerns are there. My own sense is that, there is actually a dearth of opportunities now, given that there is skepticism about how soon the growth cycle will really pick up. And we're not really talking about move just to trend growth, but really going back to the strong growth that we had actually seen. So if that doesn't happen, then money tends to move into sectors where there's some visibility, or there's an element of sector rotation which comes into play. And I personally don't think that pharma is terribly defensive right now, because the valuations also are fairly high. So you run the valuation risk. Nevertheless, given that a sector rotation does happen, it's quite possible that pharma will perform for a while. But one needs to be careful on both the fundamental factors as well as valuations. That remains key in any investment decision.
What is driving Asian Paints, Jubilant FoodWorks, Bata? Lack of options, fear, or earnings visibility?
I think earnings visibility and lack of options. So money is clearly moving into stocks or sectors where there is some visibility, and given that these are consumer plays where there's a fair amount of visibility, you're seeing valuations go up. We've been through these kind of phases before. So if you remember the 99, 2000, 98 to 2000 phase, there were just three sectors at that time which were performing, which were basically consumer, pharma, as well as IT. And we saw many of the MNC pharma companies go up to valuations as high as 35, 40 times earnings, and then obviously that didn't sustain. So I think in a sense what we're seeing now is just a rush into safety, which is driving up a lot of these valuations.
Why buy safety now? Because, locally environment has changed. Earnings globally also are not all that bad. 2011, yes, for, some of these consumer names, they managed to outperform because there was global gloom and doom. Now things are looking stable.
Well, I think they're looking a little more stable than they were a little while ago, but I'm not sure that, confidence is really coming back. So when you talk to people in terms of either investment into equities or into general investment, there is still a fair amount of holding back. And I think that brings us back to the issue we were discussing at the beginning, which is that, there is a sense of frustration that the government's not really getting its act together on many of the issues in terms of driving growth, the interest rate cut notwithstanding. And this sense of limbo may well continue into the, next general election. So as long as that remains a prevalent view, I think there will be skepticism on investment, and people are going to basically do the bare minimum. So I would be, doubtful whether we're really going to see a big pickup in the investment cycle.
What is your view on BHEL? Is it really heading to be a structural derating story?
Yeah, I think till we get the issues in the power sector sorted out, it does look like that, because, we're looking at fairly low growth in terms of the order book over a period. The competitive intensity is getting tougher. So, there's little upside really to be seen at the moment.
So let me ask you a direct one, Sangeeta. For the fiscal FY13, how are you planning to invest your money, your personal money, your son's money, and then your firm's money?
Okay, I think it's going to be a very, very stock-specific story. My focus and the firm's focus really is on smaller companies. And we basically look for companies which are undervalued, which have, a good trajectory of growth ahead, and which have strong balance sheets. So that's really the criteria that I use, and there are very few companies which are available like that. If you don't find the right company, then don't invest.
So by and large, are you fully invested?
No, I'm not fully invested in equities. I'd say I'm about 50% invested.
So when will you invest that next 50%?
In these, if I find the companies which meet these criteria. So I think one has to be very, very disciplined about investing. If you don't find the right kind of stocks, maybe it's just better to stay out till you find them.
What do you make of the, M&A activity in the mid-cap space? It started with IVRCL and then the SL Group, and now there is Buzz and Escorts. Do you see, given the way how mid and small cap stocks have been thrashed, we will see increasing M&A activity this year in that group?
I think we will see a lot of M&A activity in both the listed and the unlisted space in small and mid-cap companies. I don't know whether you've noticed this trend, but there's been a lot of M&A where the buyers have been Japanese companies. I think we will see money from, Western markets as well as other developed markets move into this pack, because whoever wants to enter India, I think a lot of people would be willing to pay a certain level of premium and buy existing businesses. So I think we're at the beginning of a fairly strong M&A cycle in both the listed and unlisted small and mid-cap companies.
Let's look at two specific names from the banking space, and they both are best of the breed, HDFC Bank and then State Bank of India. HDFC Bank is trading at a price to book of 4 times. State Bank of India is trading at a price to book of something like 1.8 times. From a 3-year basis, which to your mind will create more wealth, SBI or HDFC Bank?
Over a 3 to 4 year basis, I think SBI will create more wealth, but HDFC will give you less heartaches. So it'll be just more steady. So, HDFC is seen very much closer to, I'd say, in a sense, the consumer bank because of the steadiness and visibility of earnings.
So if HDFC Bank is growing at a run rate of about 30% plus, and it's remarkable the way they have maintained that, do you think the stock also has potential to appreciate by at least 20% on a CAGR basis?
Yeah, I think it could. It could.
What are your thoughts on Reliance? Because it's been a marked underperformer. Numbers are due today. If I look at the core business verticals for Reliance, all of them are under pressure, whether it's the refining business, the petrochemical business, or largely their, E&P business?
Yeah, I think, as far as Reliance is concerned, my own sense is that the pickup here will really begin when we have clarity, or more visibility rather, on the E&P business. Because the other businesses, there is a cycle there, and we're past the peak on some of those. So it's really, the key issue really is going to be, when we start to see the E&P business pick up. So I'm not sure we'll see too much of a performance right now. It's been range bound, likely to remain like that for a while.
Do you think Cain is a good stock for someone who wants to buy a name in the energy sector? Because for Reliance, the business environment is tough. For ONGC, there is no environment at all. Stocks like IOC, HPCL and BPCL, they are still hostage to government policies.
Yeah, I think if you want an oil and gas play, this is the cleaner play, clearly.